The trading game is a marathon, not a sprint. And the traders who succeed long-term are the traders who have learned to stay in the game. And one way to stay in the game is to minimize your risk and reduce your exposure. And the best way to do that, ladies and gentlemen, is through stop loss. Using a proper stop loss is an important aspect of trading, and it is something that will allow you to stay in the game through the highs and the lows, because if you stay in the game, eventually you will win in today's video. I'm going to be sharing how you can place a proper stop loss and the best way for you to go about doing that, so you can avoid manipulation in the market. Let's waste no time. Let's get right into it when it comes to setting the correct stop loss. The very first thing we need to understand is what is a stop loss. Stop loss is a risk management tool that is used to minimize or mitigate your risk as a trader coming into the market. Let's say you have $1,000, then you say you want to take a trade. You don't want to lose all of that money in one trade. So what you do is you follow proper risk management. Maybe you say you want to lose only $50 per trade. A stop loss is the tool that is going to allow you to do that, because as traders, we deal in probability, not certainty. You're going to lose trades, and if you can control how you lose, eventually winning will come, and you will stay in the game long term when it comes to placing the correct stop loss, so you can avoid things like manipulation, stop hunts. The most important thing to understand in the market is that with price action, you have something called swing points. When the market is not in a consolidation, price isn't moving sideways like this, it is trending. And when the market is trending, you have swings in the market price, making higher highs, boom, higher lows, high highs and higher lows. These are the swings in the market. These are the swing points in the market as price is trending. So when you are trading, you are either a buyer or a seller. If you are buying, you want to place your stop loss at the proper low of the swing points. Now, if you are selling, you want to place your stop loss at the high because it increases your chances of succeeding and price not taking you out and then going in your favor. What a lot of traders do sometimes, is especially new traders, is they place their stop loss at the body of the candle or the body of the swing. And a lot of the time it doesn't work because price can pull back 80 or 90%. So it's really important that when you are taking trades, you're focusing on placing your stop loss at the low of a swing or at the high, depending on whether you a buyer or seller. So let's take a look at the chart for an example right now. So what we see here is price is consolidating. We're getting a sideways market, and all of a sudden we get a nice big break to the upside as a trader. You're coming into the market, what you want to do is you want to focus on using this swing point. So this level, if you are going to be buying, you want to place your stop loss at this level. This is ideally where you want your stop loss to be, because this is the previous low that was formed. So as price is retracing and pulling back, you're simply just waiting. Okay, does this make sense? If you took a trade, let's say right here, that would be about 40 pips as price continue to move. Okay, maybe the market dipped down right here, and you say, wow, well that's about 34 pips of risk. Is this worth it for me? So you take your trade, you say yes, and you look to get involved in the overall trade, placing your stop loss below this low. Maybe you say, set your take profit right here. So what we see is, yeah, price dips a little bit lower, and then you see price go in your favor overall. So it's important to really understand swing points in the market, because as a trader, you don't want to place your stop loss at these levels or at the body of a candle. You always want to focus on placing your stop loss either at the high or at the low. It's literally that simple, regardless or what time frame that you are in. It is just a principle that you follow if you are trading on the 1 hour time frame and you say, hey, Emmanuel, well, 30 peps, 40 peps, or 50 peps. That's too much of stop loss. I don't want to do that. You go to the lower time frame, you go to the 5-minute time frame. Another thing you can also do too is you can watch for the market structure to shift. Maybe you didn't want to get involved right here. Maybe you watching price as the market is still forming its little market structure. Price is making lower lows and lower highs. You wait until you get the break of structure. You can place a stop loss at this low. You wait for price to dip down. You get involved and boom, you watch the market take off. So with that, you still would have it would have been a 22 pep risk. Overall, you would have been in a position where, okay, you made about 78 peps, 80 peps on the trade by just, waiting for a clear break of market structure and not using this low when it comes to placing a stop loss. Ladies and gentlemen, it's always important to use the lows and use the highs as a buyer. You want to use the lows if you are selling. The highs is where you want to place your stop loss, because when you get stopped out, you want it to be because the market has shifted or the ties have shifted and not get stopped out and watch price continue to go in your favor. Sometimes, yes, you will have a situation where price is going to take out the high like it did here, but that's not something that is going to happen consistently or all the time, especially if you're paying attention to the higher time frame as well. And that's the video. Ladies and gentlemen, thanks for watching. Always remember, the trading game is a marathon, not a sprint, and I'm looking forward to seeing you at the finish line. Cheers.